Okay, we're going to go ahead and get started. We're letting folks log in right now, so people will be slowly trickling in. So we appreciate everyone who is able to log in and watch us talk about diversifying revenue. I'm going to briefly introduce myself first. My name is Jack Wiles. I'm one of the co-leaders of the nonprofit industry group. I'm a tax director here out of our Metairie office. Been working at LaPorte for 15 years now. 14 of those have been spent in the nonprofit industry group. This is the kickoff of LaPorte's nonprofit educational series, which we are happy to say is in its 9th year of production. For those of you who have not attended in the past, what we like to do as a nonprofit industry group is hold a summer series essentially, and we get folks to come in and talk about a wide variety of topics. Sometimes it's the folks at LaPorte who talk about things, and sometimes we get outside consultants or other industry experts to kind of talk about their perspective on a given topic. So this is the kickoff of the 2023 series. This year's series is going to focus on strategic sustainability and specifically how that relates to the nonprofit industry group. And as I've said before, today's topic, we're going to focus more specifically on diversifying revenue streams and then the issues that can arise from that. We, Taylor and I, being tax folks, we are going to focus a little more heavily on the governance issues and the tax issues. Again, there are a wide variety of issues, but we are going to focus on those two main areas. What does this mean from the tax perspective? And then what does this mean from a governance perspective? So before we start, and it looks like people are still slowly trickling in, we're going to go over just a couple of housekeeping items. So I'm going to read this off my sheet here, so pardon me for that. Right now, all attendees, y'all are going to be muted and your cameras are turned off. So even if you do shout out a question, we are not going to be able to hear that. The program is going to run approximately an hour and 15 minutes, and then we're going to hold the Q&A session out after that for any questions that you may have that pop up. Questions can be submitted via the Q&A portal, and we will answer as many as we can at the close of the presentation. But if there's a bunch in there, we may not be able to cover at all. Taylor's going to kind of go over those throughout the presentation. If there's repeat questions, she'll obviously pull those back, and then we'll address that in the Q&A section. Because we are going to be issuing CPE credit for this, at random intervals during the presentation, a question will pop up asking if you are still watching. So please respond to those questions in order to get CPE. Those will pop up randomly throughout the presentation. So please try to make sure that you click a response for all of those. And then all attendees who are in attendance today will be emailed a link to an evaluation form after the presentation for CPE purposes. So again, we're going to get started. So again, my name is Jack Wiles. I'm one of the co-leaders of the nonprofit industry group. We serve a wide variety of organizations, private foundations, public charities, operating foundations, charter schools, healthcare organizations, charitable remainder, charitable lead trusts, and all those things in between. In my career, I've helped advise folks on their entire life cycle of the nonprofit, whether that's through formation, selecting the correct type of nonprofit that you want to run, helping out with operations, best governance practice, board training, reviewing 990s, preparing 990s, and then of course, wind down and dissolution of a nonprofit. Presenting with me today is Taylor Boudreau. She is a tax manager and member of the LaPorte Nonprofit Industry Group. She provides tax services to a wide variety of clients, including individuals, corporations, S-corps, LLCs, partnerships, and Taylor and I work together on a lot of nonprofits together. So she also works on foundations, charitable trusts, and then public charity as well. And she has also helped with entity formation and dissolution. So with that introduction, I'm going to pass the screen over to Taylor, who will begin the actual presentation. So Taylor, take it away.
All right, thank you. All right, good morning, everyone. All right, so some of the topics that we will be discussing this morning include current items impacting the nonprofit sector and possible changes that are along the horizon. And so then some reasons why organizations would want to diversify their revenue and advantages and concerns regarding those different revenue sources. Then what exactly is unrelated business income, or UBI? Different categories of income that could potentially be classified as UBI. So some of those might include contributions and then active and passive income, which we'll get into later. And then the relevant tax and governance issues associated with these. So where does the nonprofit sector currently stand? The nonprofit sector currently provides around 5.5% of the nation's entire GDP. So that's around $805 billion worth of output. And even though this might seem like a large amount, approximately 25% of nonprofits are operating in a financial deficit every year. And 1/3 of nonprofits have less than 2 months of cash on hand, which that can seem like a red flag from if you're hearing this for the first time. But then on the other hand, around 80% of funds are donated by 20% of your donors. So a lot of organizations are really relying on a small group of individuals or businesses to support their organization. And so donations are one of the main sources of funding for nonprofit organizations. And that is shown here in this chart. This is from the Giving USA report from 2022. Let's just also note, though, that this data does not include program income or any passive income such as investments. This is strictly contribution funding. So we can see here that around 64% of donations received is from individuals, which makes sense as individuals tend to give more than $300 billion each year to charitable organizations. Then we see around 21% of funds are received from foundations. So this can be from grants that you might apply for with community foundations. And then we see that 9% might come from bequests. So this is usually a gift made as a part of a will or a trust. Someone might leave some cash to their favorite charity or their IRA, annuities, or any property possibly. And then we see 6% is given by corporations, and then only less than 1% comes from special events. And so the biggest issue we tend to see with organizations that rely heavily on event-based giving is the low return on investment, or ROI. So there's a significant amount of work that's put in to prepare these events with very little monetary value received in return, as opposed to just a large lump sum donation from an individual or a corporation. So after analyzing this data, we can see that contributions are an essential factor in how you sustain and operate your programs and organizations. So what are some variables that may affect future or potential donations? So of course, as we're seeing all over the news, you may have experienced this personally, or I'm sure you've seen it within your organization, is inflation. It's everywhere. The purchasing power of the donations you receive not only diminish with inflation, but the amount you receive from donors likely will too. Your donor base, no matter who they are, most likely has less free cash available for charitable causes, just because everything else is so much more expensive. And then along with inflation, you have the stock market, political affairs that might be happening within the country or even outside the country that affects the economy. If your organization is in an area that's heavily influenced by the oil and gas market, I'm sure you saw fluctuations in your donations received during the downfall of the oil and gas industry. So you could not be receiving the same amount of donations consistently. It's very volatile. And so while charitable contributions from foundations and corporations has grown in recent years, the dollars donated by individuals has fallen multiple years. Charitable giving in the United States declined in 2022, and this is the fourth time in 4 decades. So the fourth time in the last 40 years that donations did not increase year to year. So this can be alarming for some organizations that heavily rely on these individual contributions. And then, of course, another variable we have is our favorite thing, tax laws and policies. They're constantly changing and evolving. Currently, for charitable contributions, particularly individuals, to receive any sort of tax benefit, you must itemize on your tax return. So that's Schedule A of your Form 1040. But what I found to be interesting was that recently in the House of Representatives, the Charitable Act was introduced on May 17th. So this is House Bill 3435. And so if this is passed, taxpayers who do not currently itemize would potentially be able to claim charitable contributions up to 1/3 of their standard deduction. So this would be about $4,600 of contributions for a taxpayer who files single and around $9,200 for those that file married filing jointly. And so while this might not seem like a large dollar amount, currently about 88% of taxpayers take the standard deduction. So if this were to be passed, this could create new opportunities for new classes of donors to engage with the nonprofit sector. Millions of taxpayers would now to be able to support the work of nonprofits that might be in their communities that they may not have had the chance to do so before. And so we see that contribution revenue is a main source of funding, and all these variables can affect money received and will not always remain consistent. So you might be thinking, am I the only organization that's facing this struggle? And so you are definitely not. The top 4 revenue streams for nonprofits currently are fees for service, charitable contributions, corporate philanthropy, and government grants. And so those last 3 are all different types of contribution funding. Therefore, these are reluctant to the variables that we previously discussed. And so you might be in a board meeting or holding a finance committee meeting, and someone may pose the question, we're seeing all these variables affect contributions, but is there something else that we can do to generate more revenue or maybe shift some focus to? How can we try to avoid these variables or make them work to our advantage? So that's where the object of diversifying revenue comes into play. You might have heard the age-old saying of, don't put all your eggs in one basket. And so that's even true with your own personal investments. If I'm investing in the stock market, I don't want to put all my funds into just oil and gas companies or only tech companies or even just Bitcoin. So we're going to go through some of the advantages and also concerns of diversifying your revenue streams. So one of the first advantages that we see is flexibility. So essentially, you're not limiting your organization to just one source of revenue. For example, if you rely entirely on donor contributions, as we discussed before, a change in tax policy could cause a massive loss to your organization. And so this might make people think twice about their charitable gifts. Foundations might change their giving priorities, or governments might move their contracts to other organizations. Or if you rely on a large yearly activity to provide funds for your organization, such as a gala, then I'm sure you experience the pitfalls of COVID and how that can shift your revenue. And so also, if you rely only on grant money alone, your organization will face ebbs and flow in revenue with grants that are cyclical. A lot of grants come in wave, but grants also have a fixed beginning and end. And so with other sources of revenue, your organization would still be able to remain afloat if there is another health crisis such as COVID-19 or an economic downturn, or even a natural disaster such as hurricanes, which I'm sure some of us are accustomed to. And so we also have autonomy. So by diversifying your revenue, your nonprofit can have autonomy over where your money is allocated. So if you only have, let's say, donor restricted funds, then allocation to some of your programs might be limited. Oftentimes grant makers prefer to dictate where their donations will be allocated. And so this assures them that their money is being used for their preferred initiative, rather than possibly maybe some additional overhead expenses you might have. And so if a nonprofit receives all their money from government contracts, let's say to provide mental health services for part of their state, they don't have much autonomy over where they can allocate their funds to. So by diversifying your revenue, you do end up having more control over the allocation of your funding. You might be able to focus spending on items that are more important to your organization at a possible certain point in time. And then another advantage that we tend to see is increased exposure, or there's a fancier term called community embeddedness. And so this refers to your credibility. So do potential clients or other donors know about you? Are they aware of your mission and your programs? Diversifying your revenue streams can open the door to building connections with local businesses, even government agencies, and the general public. And so only having one revenue source tends to limit your exposure as an organization. So the more visible that you are, the more that people can get involved in your efforts. And so now that we've gone through some of the advantages, these are some of the concerns that we tend to see with diversifying revenue. So of course, when you take on something new, there's always going to be increased complexity and risk. Some revenue streams are more volatile or just harder to maintain than others. Every time a new revenue option is pursued, the complexity of your portfolio is increased as well as your expenses. And so diversifying requires an analysis of that particular revenue stream. That might include an assessment of startup costs, capital needs, risk and concerns that would become true if you were to take on this additional revenue stream. You might also need a special dashboard or even additions to your current dashboard so that your board and others can measure the costs versus the benefits. And so you can't always eliminate risk, but you can mitigate it by being prepared. And so we also have this term called the crowding out effect. So this occurs when potential donors shift their decision-making when they observe your other sources of revenue. So for example, if your organization, let's say, offers a t-shirt for $20, potential donors might see this as an alternative to making a cash donation instead of just $20 in cash. So someone who would have previously made that donation is now buying a $20 t-shirt. And so the contribution that you technically end up receiving is the $20 less the cost of the shirt. So in actuality, you're receiving less funding. And so sometimes crowding out is inevitable. So sometimes you have to make trade-offs down the road. And then also another concern that we tend to see is the possibility of jeopardizing your tax exempt status, which I'm sure is something none of you want to do. Will this new revenue stream and this time spent on this new activity distract us from our mission? And also, if I'm a publicly supported organization, will this new revenue stream cause me to fail the public support test on my tax return? If you fail this 2 years in a row on your tax return, that starts to raise some questions and a red flag with the IRS. And then also with, getting into these different types of revenue streams, you may also be succumbed to unrelated business income, which we'll go into depth more a little bit later. And so depending on the type of new revenue stream you might have, UBI might be produced. And so you have to sit back and think, do I have too much? Is this UBI or new revenue stream overtaking other activities that are related to my mission? And so now that we've gone through some of the advantages and concerns, you might begin to question, what are other nonprofits doing for different types of revenue streams? And so this is just a compiled list of some other revenue streams that we might see, and your own nonprofit organization might already be participating in these, whether it's, selling merchandise or paid training or workshops. Some of you might already have member dues and fees in your organizations, as well as passive income and endowment and donor advised funds. So there's definitely a lot of options when it comes to pursuing additional revenue streams. But regardless if you decide this is something you want to pursue or not, it does, there are considerations that you should take into account. And this might be discussing with your other board members or even the executive director of your association. So, you want to evaluate your current streams of revenue first off. How is your organization currently bringing in revenue? And what are we doing that's working and what isn't? And then you want to identify opportunities for new revenue streams. So what is something that we might already have the means to implement, but we're not currently doing? And also, what are other nonprofits doing that might be in our area or that have missions similar to ours? And then you also want to create a plan of action. So remember that depending on the size of your organization, some revenue streams might require a full-time staff person. So you want to plan accordingly. You need to determine if you're going to need to hire more people or if you're going to lean on volunteers. Also, if you need to contact your lawyer or your CPA, do we need to update our bylaws? Things like that. You just want to be prepared and have a plan of action. And then if you do decide to pursue with a new revenue stream, you want to test your assumptions. So not every new idea you plan to implement will work specifically for your organization. So before going all in, you kind of want to find a way to test your plan with minimum time and money spent. And then once you do implement this new revenue stream, you want to continue to evaluate that income. There's no guarantee that this new revenue stream will remain successful. So make it a habit of continually analyzing the results of your efforts. So as we can see, diversifying revenue is sometimes easier said than done, and choosing to or not to may depend on the sophistication or specific needs of your organization. For some, it might be better just to focus on one source of revenue and really try to nail that down, or instead of diversifying too quickly. Ultimately, you know your organization the best, so I would suggest just bringing this up as a topic in conversation a few times a year with your board members. And so let's say, after hearing all this, you do decide to pursue, a different source of income. But I remember Taylor mentioning something about unrelated business income. What exactly is that? So the IRS defines UBI as income from a trade or business that is regularly carried on by an exempt organization and that is not substantially related to the performance by the organization of its exempt purpose or function, except that the organization uses the profits derived from this activity. So in simpler terms, that basically just means any money you generate from an activity not related to your tax exempt purpose. And so an activity is typically considered UBI if it meets 3 criteria. So the first one is that it earns income from a trade or business, that trade or business is regularly carried on, and that trade or business is unrelated to your organization's mission. So first we have the trade or business requirement. So in general, this is any activity carried on with a profit motive. So this could be the sale of goods or the performance of services. And so some factors that need to be considered are the expertise of the taxpayer, the manner in which the activity is carried on, the time and effort expended in the activity, and the history of success. And so all of these factors, not one outweighs the other, and they must all be relevantly weighed. So let's say that your nonprofit organization decides to sell t-shirts with your logo on it. That would meet this trade or business requirement because you're in an activity that's being carried on with that generating profit motive. And so our next criteria will be that the activity is regularly carried on. So from the regulations, this states that business activities ordinarily are carried on if they have a frequency and continuity and are pursued in a manner comparable to similar commercial activities of non-exempt organizations, or essentially for-profit organizations. So some examples, let's say we go back to that example, you have one fundraiser a year that raises a lot of funds for your organization. So an annual gala. This is only held one time a year. You typically don't see a for-profit entity holding a fundraiser to raise funds. That's a normal business. So this annual gala is only held once a year. So that would not meet the criteria of being regularly carried on. As opposed to, let's say, your nonprofit organization's animal shelter, you run a summer snowball stand. And so even though you might use the funds for the animal shelter, your snowball stand is competing with other snowball stands that are operating for a profit. And so snowball stands are typically only open during the summer. So this would be a regularly carried on event as you're operating during the same time as for-profit entities and competing with their business. And then the last criteria we have is unrelated to the exempt purpose. So also, as the regulations state, this is an activity that generates business income that normally must bear a substantial causal relationship to achieving an organization's exempt purpose to avoid classification as an unrelated trade or business. So again, some examples, let's say we have a children's performing arts organization and they're selling tickets to their spring play. This is related to their exempt purpose, their performing arts organization. So this example would not meet this criteria. Then also we have trade union fees for training seminars for members. That's part of their exempt purpose. And on the other hand, we have a boys club. They're operating a year-round car wash. Car wash that's year-round. That's usually not going to be related to your exempt purpose. That's just, a means of raising revenue. And so using income for a mission-related purpose does not shield the income from tax liability. It's the activity that generates the income or loss that triggers unrelated business income to be taxed. And so, as always, there are exceptions to every rule. There are activities that are excluded from being classified as unrelated business income. So I'll just kind of touch on some of the more common ones that we see, and those tend to be convenience of members. So if an activity is conducted for the convenience of your employees or those that are served by the nonprofit, then that activity is usually not subject to UBI. Also, some other common ones that we see are hospital services, selling donated merchandise. You might think of a thrift store. If all the merchandise you receive is a donation and that's sold, the profits are not subject to UBI taxation. And then also volunteer workforce. Typically, if at least 85% of your activity is conducted by volunteers, then that is also not subject to UBI tax. So after knowing this, let's go through a few examples to see if these situations would be classified as UBI. So if we have a lunchroom at a local nonprofit zoo, again, this would go back to the convenience factor. So you're meeting the convenience of your members and others that are served by the nonprofit. Therefore, revenue associated with this activity would not be classified as UBI. Let's say I'm a folk art museum and I have a gift shop and I am selling some scientific books. Now, if I were to be selling books that were teaching kids about folk art in my folk art museum, this would not be subject to UBI. But because these are scientific books, this goes back to that criteria of not being related to my exempt purpose. These scientific books are not about teaching others about folk art. Therefore, this activity could potentially be subject to UBI taxation. Let's say I have a hospital that has a gift shop and it's all volunteer run. So again, going back to this exception of volunteer workforce, the revenue generated from this would not be subject to UBI. And then lastly, let's say we have a church located near a sports stadium and they decide to sell parking during events. So, let's say we have the Superdome, or for those of you in Houston, we have NRG Stadium. There's sporting events going on all the time, where there'd be football, and then there's also, other events such as concerts. And so even though football is only a certain type of the year, with all these other activities, that meets the criteria of an activity being regularly carried on. And if they're selling these parking spots, they're obviously trying to generate a profit. So then again, that trade or business requirement would be met. And then also a church selling parking, that's not really related to their tax exempt purpose. So this is a type of activity that would be subject to UBI taxation. And so obviously, if you're ever in doubt, if you have UBI, always ask your CPA. And so, after hearing some of these situations, you might think to yourself, oh no, the new revenue stream I decided to pursue, I think I might have UBI. So now what do I do? And so Jack's going to kind of take us more into depth about what UBI is and different incomes that might generate that.
All right, scoot on over here. Thank you, Taylor. So the next thing we're going to cover, like Taylor said, is, okay, we've done the analysis. We believe as an organization that we have unrelated business income. Now, what do we do? The first thing I'm going to say, as your CPA that you've contacted and let us know that you think you have UBI, is don't panic. Automatically having unrelated business income and reporting that does not send a red flag up the pole. There's no red phone on an IRS agent's desk that starts ringing, notifies them that your organization's up to something not good, right? So take a big breath, talk to your planners and your advisors, and just figure out what it is that you need to do. What you need to do is understand the rules and the reporting requirements of unrelated business income. Once we understand what we have to do and how we have to do it, we can then file the forms that are needed, pay the tax, if any, that's due, and move on with our life, right? And then the third thing I'm going to recommend is enjoy the money. The whole reason that you took on a new revenue stream was to either help subsidize your programs, provide a future cushion for the organization. You went about this endeavor to generate that money. So let's just be excited that we have some revenue that we can use to our advantage and move on from there. So I talked about understanding the rules and the reporting requirements. So what exactly are those reporting requirements? Well, if you have more than $1,000 of gross UBI, so that's that top line number, that revenue, you have to file a Form 990T. Okay, why $1,000 seems kind of like an arbitrary number? Well, every 990T that you file, you're allowed a $1,000 exclusion by the IRS. So anything below that, it's really too small for them to worry about. They don't want to deal with the paperwork. So they just say anything below that, don't worry about it. If it's above, then you start reporting, right? And then you also have to understand, because the 990T is, is a federal form. We then also have to understand that state tax also may apply in certain situations. And like anything in state tax law, each state has its own different opinion on whether or not it's going to tax unrelated business income. Louisiana says, yes, we are going to tax unrelated business income. Texas, no. So it's important that once you understand what we're doing on the federal level, we also understand what we need to do on the state level from reporting. Again, on the same issue with the Fed as the state, merely reporting this activity does not send up a red flag, does not put you on any kind of watch list. You're just you reporting the income is doing what you're supposed to do, right? It looks favorable in the IRS's eyes. Okay. So then once we know how we have to report it, once we go into the nuts and bolts, what's the taxability of unrelated business income? So on this slide here, I've given you kind of what the historical range has been. Rates, typically whatever is applicable to corporations in that tax year is what you would be taxed on for UBI. Historically, that's ranged anywhere from 15% to 35%. Right now, it's at 21%. So you can see it's a wide range. Currently, we're at that 21%, and you're really kind of at the mercy of whatever party is in office and wants to enact different tax laws. Some are more aggressive on unrelated business income. Some don't care as much. It just depends what's currently in law. And then also know that you have to know the state rules when it comes to the taxability. States typically have a much lower tax rate, so not as quite a big of a ding to your pocketbook. Louisiana can get up to 7.5%. But again, each state taxes this kind of thing differently. So you have to know your individual state's rules. Also, when it comes to taxability, the way you calculate this is like you would in any other for-profit venture. So just because my parking lot that I've determined is unrelated, and it generates $10,000 in revenue, we don't pay tax on that $10,000. We're allowed to allocate all appropriate expenses that were used to generate that particular income stream. So that could be anything from direct expenses, wages, materials, supplies, anything like that, advertising, then to overhead. So did we have to incur any utilities, that kind of thing. So you're allowed to offset that revenue with the appropriate expenses. So keep that in mind as well. That also could be take in mind that you may actually have more expenses than you had revenue. In that case, you have a loss and there is nothing to tax, right? Ideally, we don't want a loss if we're trying to generate more revenue, more income for the organization, but it does happen. So be aware that that can occur. Okay, next I'm going to talk about is siloing of activities. We're still kind of working on the nuts and bolts of how do we report all this stuff. So siloing of activities is a fairly new concept in nonprofit tax law. So in the good old days, what you would do if you had multiple unrelated businesses that you were reporting to the IRS, you would take each of those entities separate and calculate the net income or the net loss from each activity. And then you would smush them all together and report that net number. So if you had activity A that had income, activity B that had a loss, and activity C that had a loss, you would smush all those together. And if you had a net income position, you pay tax. If you had a net loss, you carried that loss forward. As part of the Tax Cuts and Jobs Act, 4 or 5 years ago, when that was enacted, they needed to come up with some funding somewhere to subsidize some of the other provisions of that act. And so what they decided to do is we are going to now silo activities. And so each separate activity is reported and tracked separately. So if we go back to that same example, we have activity A that has net income and activities B and C that have net losses. We no longer can just aggregate all those together for that net loss. We would have to report A and pay tax on the income from that one, and those losses from B and C would carry over to the next year. In the next year, if activity B had income, you could use that loss that was carried over from the prior year to offset that income. So it sounds like a lot, but conceptually it's pretty simple once you sit down and kind of work through it. But it's something that has changed over the last few years. And if you're used to kind of the old regime where you can mash everything together, I just kind of want to bring that to your attention if you haven't done this in a while. So are there limits on UBI? So Taylor mentioned that yes, nonprofits are supposed to engage primarily in activities to accomplish a tax-exempt purpose. So the IRS has said that, look, if your unrelated activity rises to too high of a level, you can lose tax-exempt status. That's obviously worst case scenario. Unfortunately, like a lot of tax law, and because a lot of this analysis, like Taylor had mentioned, is so facts and circumstances based, there is no fine line in the sand on once you get over this threshold, you lose tax exempt status. If you recall, I had said that the entity must engage primarily in activities related to tax exempt purpose. If after this presentation, you were to go online and Google what is the limit for unrelated business income before I lose tax exempt status, if you read 5 different articles by 5 well-respected tax practitioners, you'll probably find that it's 5 different opinions on what that exact threshold is. In my opinion, typically, if you're up to that 0 to 15, 20% area, you're pretty good and don't have to worry. Anything above that, you really got to bring in your professional advisors, get tax attorneys, your CPA, someone who's well-versed in nonprofit tax law and really start documenting the file and making sure that you and the organization are comfortable with the positions you're taking and that you're not jeopardizing your tax exempt status by having too much unrelated business income. So unfortunately, no line in the sand on where that number is, but it's a facts. Good thing is it's a facts and circumstance based analysis. This is also kind of when I would warn y'all about water cooler talk, or when you're at the networking events for other nonprofits, and you may hear another organization, oh, we have UBI, it's super successful, we don't pay taxes, we're not worried about the size of it. Always be careful, because you're probably not comparing apples and apples. They may be using the volunteer workforce exception that Taylor mentioned. You may be using paid employees. So it's very rarely is it a one size fits all approach. Okay, so now we're going to kind of, what exactly are we going to talk about when it comes to the different categories of revenue that we could be generating? We're going to talk first about contributions. There's going to be 3 specific kind of subcategories of contributions that we're going to touch on. Then we're going to talk about active income, which is something that we have a hands-on role in generating that revenue, and then passive income, which is we are hands-off with generating that money. Okay, so traditional donations. This is kind of an easy thing to conceptualize. And when we're talking about diversifying revenue, a lot of times you'll think of, oh, let's start a new product line, let's start selling t-shirts, let's open up a cafe, let's do all these other things. But sometimes it's just as simple as, let's tap into a different donor base than we historically have. Let's do a different type of marketing campaign. Maybe we've never done a capital campaign, or we've only done online. We've never done a gala or a gala. So sometimes it's just as simple as tapping into a new type of contributor. Let's go through some just super easy examples. Let's say we have Aunt Sally, and every year she gives $50 to her favorite animal shelter. So like Taylor had touched on, individual giving makes up the bulk of charitable giving, right? Aunt Sally might also own a bakery, and every year that bakery gives $100 to that same animal shelter. So there's that other huge hunk of that pie chart that Taylor had mentioned, where it's the corporate giving. So that is her business giving, right? Those are 2 different donor sources, 2 different approaches, probably from your fundraising team, 2 different asks, right? So maybe that's all we've historically done, but we've talked, maybe we really need, we've got such these long-term donors, and their businesses have given us for decades now. What if we need to start tapping into end of life giving? Maybe towards the end of we want to be put into their will. There's these bequests, right? Maybe once that same Aunt Sally passes, she leaves her entire estate to the organization. And we will talk about how that can be a little complex further on in the presentation, but maybe we need to start doing some other charitable fundraising. So I think this, as you can see, quick 3 different types of traditional donations, but it's a good time where you could to kind of talk about, okay, we need to make sure as an organization, if we're going out and diversifying our asks, when we're going out there and going to these different donor sources, it's time that we may have to revisit our gift acceptance policies. So we had said that we're going to talk about governance issues and tax issues. One of those governance issues that we really need to be aware of is those gift acceptance policies. If Aunt Sally or her business give us cash, $100, $100, $50, that's pretty easy. We take the cash, put it in the bank, we go on. But if we start getting into that end of life giving in these charitable quests, we don't exactly always know what's in her investment portfolio. What if we weren't perfectly clear with Aunt Sally on what we were willing to take, and she leaves us 100% of her bakery? What are the challenges there? It's if she leaves us stock, super easy to sell stock on the exchange, right? As an organization, you've probably done that a lot. Not so easy to sell a bakery, right? We don't want to be in the business of making pralines and cookies. So what do we do with this other fixed assets? Also, as the world is changing, Aunt Sally may want to always give us $50, but her nephew might have a very advanced crypto and NFT portfolio. What are the unique challenges of accessing that particular type of donate? We need to understand the rules. How do we even accept crypto? Do we have the technology to be able to accept crypto and NFTs? Are we going to hold on to this? Are we going to sell it immediately? Do we even know how to sell it? Those are the kind of things, as we get more and more elaborate with what we're accepting as gifts, we really need to sit down and analyze. How do we handle the donations of those business entities? Like I said, Aunt Sally leaves us her bakery. Do we hold businesses and try to operate them? You don't see that too common, but do we have contacts that we were able to say, hey, do we have a business broker who can go out there and try to market this business? Do we just say that, no, we don't take donations of active trades or businesses? I'm not telling you each one of these is the right or wrong approach. It's more, what do we have the sophistication as an organization to handle? And what do we have the time and experience to be able to do? What is our risk tolerance here? And then if I'm a public charity versus a private foundation, there's very different rules when it comes to owning business enterprises. So we got to be aware of all those and make sure that we're taking that into account with our gift acceptance policies. And then think of even more cumbersome assets like, okay, Aunt Sally leaves us her farm in northern Mississippi. It's just a bunch of vacant land. It's a lot of acreage. What are we going to do with that? It's a lot harder to sell land than it is to sell stocks. Now, even different than selling a business, we've got real estate taxes, insurances, other hunting leases. There's all kinds of things that can go on with just taking on these assets. So if we're going to diversify our ask, let's make sure that we update our gift acceptance policies to reflect the new donors that we're approaching and the new types of assets that we're asking them to give us. So that's the traditional donation bucket. So how about sponsorships? These are really kind of broken into two categories in my mind. There are qualified sponsorship payments and advertising. And qualified sponsorship payments, those are not considered unrelated business income. Whereas if you do your analysis of your sponsorship program and you realize that you have advertising, that is subject to the unrelated business income rules, or could be, right? So what is a qualified sponsorship payment? That is any money that we receive without the expectation of any substantial return benefit. So let's say an organization, Aunt Sally's Bakery, wants to give us $10,000 to be the premier sponsor of the gala, or to get her name on a hallway in our building, or name the building, right? If that is all we are giving her as naming rights or acknowledgement in a brochure, then we have received qualified sponsorship payments because they have not received any substantial return benefit from that, right? But let's say in the example, what if we are Taylor had mentioned earlier, that children's performing arts studio or organization, and a major donor gives us $50,000 of to name the theater after them, but then also wants box seats for every production, and they want to be able to bring 20 of their most important clients to that. They are now receiving some sort of benefit, and we have to go further in our analysis to see if that's considered substantial or not. So that, again, a lot of the stuff, there's entire 2-hour CPEs on. We're not going to touch into the in-depth of how we do that analysis, but just know that if someone is giving us money for a sponsorship and receiving something back, we have to do a second layer of analysis to determine if that is substantial, right? Advertising. So advertising is anything that includes qualitative information about that organization that gave us funds. So let's say Coke wants to put their name in some of our marketing materials, or on the brochure, or throughout our organization. And it doesn't just say Coke, proud sponsor of the organization. It says Coke, way better than Pepsi. We've now added some qualitative information on that display, right? And that is when the IRS is very clear. We've now touched into the advertising world, not just the sponsorship world. If there's pricing information in that advertising, or if the organization is endorsing the actual product, probably not too common with most of my clients, but you would see that in like the university setting. A coach is out there talking about the big sponsors of the university. Realistically, the qualitative issue you're most likely going to see is some sort of pricing information, or we're better than our competitors. So just be careful, understand the rules, and make sure you do an analysis anytime you're having sponsorships or any other type of possible advertising. So when it comes to these charitable contributions, what are the tax considerations? So we got to understand what bucket we fall into. Do we have a donation, a sponsorship, or advertising revenue? And then once we've made that analysis, do we meet those UBI standards? So like Taylor had talked about at length, is it a trade or business? Is it regularly carried on? Is it related to my exempt purpose? So do that particular analysis. So once I've done the analysis, if yes, I do meet that threshold, am I tracking the necessary information? So I'm giving the finance committee a heads up. Look, we're going to have to report this. We're going to have to come up with some sort of tax due possibly. And then it's also immediately letting your CPA, whoever does your tax filings for you, aware, because a lot of times if you're in an income position, you might have to pay quarterly estimated payments. So give your CPA a heads up. They'll know what to do from there, but keep them in the loop as always. And then make sure you're tracking, after that conversation with the CPA, make sure you're tracking all of the necessary information, my revenue, my expenses. Do I have to pay taxes? Am I in multiple tax jurisdictions for state purposes? Am I filing the right returns? And then something you're all very familiar with, donor acknowledgement letters. Do my letters have everything that we need in them? So that I will advise everyone, if you've never read it, publication 1771, probably the most easy to read of all the IRS publications you'll ever go in there, but it gives you all of that information that you need to include to your donors. The necessary 501c3 language, whether or not they've received goods or services, fair market value. How do I determine fair market value of the benefit they receive for their donation, that kind of thing. So keep that in mind if you ever need to, if you're ever reassessing your donor acknowledgement letters and we want to see exactly what needs to be in there, publication 1771. Then the governance issues, making sure the board, finance committee, exec committee understands the UBI triggers. And if we've had any revenue streams that we've analyzed, making sure everyone's in the loop, right? And then do we have the correct processes that protect the organizations? The one that we've really talked about the most right now is those gift acceptance policies and procedures. What are we willing to take on as an organization? What are we refusing? Have we updated it recently to meet our new donor bases and new asks that we're out there in the community doing? Okay, so now that we've covered donations, we're going to talk more about the active versus passive income. Active income, anything again that we have a hands-on role in performing. Then passive income, those are your set it and forget it type income streams. So both active and passive income streams, the legal structure that is set up is very important. So we're going to kind of take a few minutes to talk about the different legal structures that you can run into when you're diversifying revenue streams. So various legal structures and the differences between the two. So out there, there's what I would consider informal agreements. So that could be just a handshake deal, some informal joint venture, some kind of just contract you and another organization have. That's what I'm talking about when I think informal, not a separate legal entity in and of itself. Then we have partnerships. So anytime two entities come together and there's more than one owner, you automatically have a partnership, right? There is a partnership between two folks or more than two folks coming together to do perform a business. Then there's S corps. So this is a corporation that has elected to be an S corp, which has a flow-through treatment of all its income, expenses, and assets. So I'm gonna go back to partnerships because I should have harped on this now. That is what is called a flow-through entity. So all income, expenses, credits, activity flows through the partnership down to all the separate owners based on a predetermined amount. Could be ownership, could be an operating agreement, those kind of things. C corps, that is what you think of when you think CVS, Walmart, corporations that are separate and distinct entities, right? And then we have single member LLCs. What a single member LLC is, it's a limited liability company. So from a legal standpoint, you get that liability protection that your attorneys work hard to provide you, but then it is owned only by the organization. And for legal purposes, separate and distinct entity. For tax purposes, it is what is called a disregarded entity. So it is if it doesn't exist at all. The activity of that LLC is considered to be the activity of the owning organization, which we'll talk about a little bit more, is important when it comes to the tax and reporting issues. Okay, so how do these different structures affect the organizations? So the informal, it's as if the organization itself is performing that, right? There's no separate legal entity. Like I said, with partnerships, where you really have to be careful is, yes, it is a separate legal entity, or can be a separate legal entity, that all the operations are happening within that partnership itself. But all of that activity is considered to be done by all of the partners of that partnership. That becomes important when we talk about unrelated business income. So let's say that partnership is unrelated to the mission of the organization, so it meets that threshold. it would then, that unrelated business activity, if there's only two partners, we'll keep it simple, 50% owned, 50% of the net income from that unrelated business income activity would then flow through to the owners. And then you weigh that amount in relation to the total organization. So that's the amount that flows through. That is what you have to analyze when we're seeing, is my UBI level too much? Also, where you can get in trouble is because that activity flows through to the owners and is considered the owners that have the activity. If you, let's say you have a for-profit entity that is a majority owner, so let's say they own 75, you own 25, so they really are running the show, right? One of their best friends decides to run for office, and out of that partnership, they give money to his political campaign. That immediately, all of you are experienced practitioners here, that should set an alarm bell off for you. Oh no, 25% of that political campaign activity now flows through to the tax exempt entity itself. And now we have to deal with the repercussions of, it's considered that we gave money to a political campaign. So you got to be careful. We got to make sure that our articles of incorporation, the operating agreements, all are set up so that we can protect ourselves as an organization. We can make it so that those articles call that the charitable mission of that business reigns supreme in all decisions and not necessarily bottom line. S corps, where you need to be careful is in that Aunt Sally example. Aunt Sally, let's say that bakery was an S corp. She gives you 100% of the S corp when she dies. S corps are automatically subject to unrelated business income. Doesn't matter. So the activity that flows through to the entity is subject to UBI. And if you ultimately decide to sell that stock because you don't want to deal with it anymore, the gain on that sale of stock is also subject to UBI. So if I've seen entities and organizations, clients of mine, where someone gives them some stock, they weren't fully aware that it was an S corp. Now we've got UBI, or someone passes away and leaves a business entity and they weren't fully aware of all the rules, and now they are stuck with this entity that's churning out unrelated business income. And then C corp, which a lot of times in the nonprofit world is referred to as a blocker corporation, because it is a separate legal entity. All the activity inside of that C corp is considered separate from the entity, so it can churn out unrelated business income till the cows come home. It pays taxes. It can give dividends back to the tax exempt organization, tax-free. We'll cover that in a second as well. So as you can see, what you think would be, hey, this business got set up, or we were gifted a business, could be the same business, but the way that it is set up from a legal perspective has a lot of consequences to the organization, depending on what type of legal structure that is. And also the tax and reporting issues are very different. Partnerships file a 1065, S Corp's an 1120S, C Corp's an 1120. Single member LLC doesn't file a separate return. So we got to really be aware of how these things are set up if we're going into business with someone else, even if it's just related to our mission, unrelated to our mission. So I know I really kind of went in the weeds there, but what you think could be a very innocent gift from a donor could really cause a headache if you don't properly vet or have the proper processes in our gift acceptance policies, where we have a checklist of, here's the analysis we do with any kind of trade or business that we're going to be a part of. Here's how we protect the organization. So tax considerations, make sure what we have to report. If there's UBI, make sure we report that. And then the governance issues is always our gift acceptance policies. And if we are in a trade or business, do we have the right legal documents and oversight to make sure we're doing the right things? Probably a good idea if we're going to get into this trade or business world, making sure we have a competent nonprofit tax attorney, either on the board who's willing to help us, or who can we can call to ask their advice. And then also making sure that our CPA has experience in the nonprofit area. So then active income. There's related and more active income, related and unrelated activities. Sometimes we're not really going to get in. I think y'all understand what related activities are. This is the stuff we're doing it for our charitable mission, and we've already covered unrelated. What I do want to cover in this, because I don't think we talk about it more in later slides, is make sure that there is either an annual or fairly regular analysis on when to make sure that everything we're doing is related. I have seen where our clients will have let's say they get very good at a process. They have a training program for their constituents. It's completely in line with their tax exempt status, but they get very good at some training concept within that teaching. One of the members of the board is like, wow, this would be awesome if you could come to my business and train my employees on this, or I have a buddy who is kind of in a similar line of work, would you go over there and do a training seminar for them? Now we're training people outside of our charitable base, and we may have unrelated activities. Maybe it's a one-time thing, but we got to do that analysis. And then also understanding annually we look at it to make sure that it's not growing out of control. Let's say that we still have our standard related services we're doing, that training for our constituents, but that part for the board member and his buddy, they tell another buddy, and the next thing we know, this thing is cranking out $300,000 of revenue. So we got to do we need to get this out and do that C Corp blocker we talked about, protect the organization? Do we need to throttle back because we really just don't have the manpower? So keep doing that analysis. Don't let it just years go by without you ever kind of rethinking all your activities. So now we're going to talk a little bit more about sales of merchandise, fundraising revenue, and then gaming activities as different types of active income. So the sales of merchandise. So Taylor talked about this a little bit, but sometimes when we could sell a t-shirt, it could be considered excluded and not subject to UBI. We could sell that same t-shirt and it could be taxable, right? Maybe we only once a year print out 30 t-shirts, we sell them, that's it. It usually takes us a day or two. Let's say we sell that same t-shirt 52 weeks a year. Could be the same thing, but now we've got a regularly carried on component, which is one of the three things we have to worry about when we're analyzing UBI. Also, that t-shirt may just have our logo that might have different rules, as opposed to if we're like Taylor said, a folk art museum, and that we're selling a t-shirt that has a picture of one of the folk art paintings that we have hanging in our exhibit, right? That's related. So let's understand what we're selling in a gift shop scenario. Let's think about another super easy example. Let's go back to Aunt Sally. Let's say she loves our organization and says, hey, how about I open up a little like stand inside in your building and I sell my famous cookies all year round in here, but I'll give you the cookies for free. You sell them. Actually, the donated thing could be an exception. So she gives us the recipe. We start buying all the ingredients. We start selling them. We keep the profits. Most likely that's going to turn into an active trade or business. And now we've got UBI. But I know another famous cookie fundraiser. If you think the Girl Scout cookies, where it's a very short, very distinct minimum bit of time where we're selling these Girl Scout cookies. So a very different set of facts and circumstances that we would have to analyze for UBI considerations. Also, now that we are selling products, right, we have to worry about sales tax. Taylor and I are not sales tax experts, which is why we only have a bullet point and not an entire slide, but there are different rules for different jurisdictions. And so understanding when you have to collect and remit sales tax, when we have to pay sales tax for products that we're going to resale, make sure that if we're going into this type of revenue, that we understand all of the rules around that. Understanding the UBI standards, whether or not we meet those thresholds. And then also if we are, let's say we get tired of selling all this product, so we hire an outside third party to sell these products for us. That is a different set of analysis you have to do in order to determine whether or not you have UBI. So just make sure that every time you make a UBI analysis, if anything ever changes in your particular fact pattern or the way you are doing business, make sure you readdress your UBI analysis, because one small tiny change, as Taylor or I can tell you, can completely change the answer, right? So make sure we're constantly doing that. Go to the governance issues that we have to worry about. One, staffing. If we're selling products, do we have to have someone, if we're doing it all year round, do we have to have someone dedicated to doing this or not? Unfortunately, we've got inventory tracking that we now have to take into consideration. If we're buying and selling stuff with different outside third parties, contract structure, are we protecting the organization? It's not on here, but if we're doing online sales, now we have to worry about whether or not the folks buying those t-shirts, whether their confidential information is safe. Are we updating our website to make sure that their credit card information isn't going to get stolen, that we're not keeping information that's easily accessible for hackers? So these things get complicated quickly. So make sure the tax rules apply, but also make sure we're worrying about all those other issues that pop up when we're taking on new revenue streams. So fundraisers, there's 1,000 different forms of these, right? The annual gala, selling Girl Scout cookies, snowball stands. Every organization does it a little bit different. when is a fundraising event taxable versus non-taxable? So Taylor talks about this a little bit, but it's the regular UBI analysis. Is it a trade or business? As Taylor said, yes, this is always going to be considered a trade or business. Where is it regularly carried on? That's what we really have to hang our hats on when we're thinking about fundraisers. And then is it unrelated to the mission? Most likely, if it's a fundraiser, it's unrelated. So we got to work on, is there another way that we can exclude this from unrelated business income? So let's just kind of go on some examples of fundraisers. Annual gala, it's only one night, so, or one time a year, not regularly carried on, right? So we don't have to worry about that. A week-long lemonade stand. If it's only 1 week of a year, probably not going to be that regularly carried on standard. The example Taylor talked about, a snowball stand operated during the summer. With this, the IRS says, well, look, snowball stands are only operate in the summer. You operate the entire summer, so that's regularly carried on. So a different fact pattern. A car wash that runs all year, we're now regularly carried on. So now we got to say, can we get out of unrelated business income through some other type of exclusion, the volunteer exclusion or something like that. So I think this is a pretty easy topic, but what are the other issues? Donor letters, making sure that we've got any fair market values of goods or services they provided. If we've got an annual gala, it's a sit down dinner. Are we factoring that in and letting our donors know that, hey, you gave us $100, but you also got a $25 meal with it. So giving them all the appropriate information on that donor letter so they can report everything on their tax return correctly. I think that's all we really want to cover for fundraisers. Oops. All right, gaming. So what is gaming? I have a bunch of clients that go ahead and have what's considered gaming events in order to raise money. So this is bingo, pull tabs, raffles, lotteries, scratch off, stuff like that. When you're doing these, we're still going to do that same UBI analysis with the one exception. When it comes to non-taxable versus non-taxable gaming, it really depends on the type of gaming. And then bingo has a specific exclusion where bingo is not subject to UBI. So if we're thinking of doing some sort of fundraiser, bingo is probably the easiest bet. But if we want to do something else, we got to do all that other trade or business, regularly carried on, unrelated to mission analysis. So the tax considerations with this, I'm going to go a little quicker because we're getting close on time. We got to understand the UBI standards. There's different reporting requirements. We have to understand that when it comes to wagering, we got to make sure that we properly report on a W-2G. So that is the wagering winnings that were won by anyone. Each different type of gaming event, broadly speaking, has a different threshold on when you have to file a W-2G. And they also have different thresholds on when you have to withhold taxes on behalf of that person. So if you're going in this area, talk to someone who's familiar with this, make sure you understand all the reporting and withholding requirements. Also make sure that you understand we have appropriate oversight over this with the governance considerations. Make sure that if my jurisdiction that I'm holding these events has registration requirements, that I'm registering with the appropriate committees, that I have appropriate oversight over all the cash. A lot of times these events, there's a lot of cash involved. So if we're used to a lot of electronic donations, maybe we have to kind of tweak the deposits, who's going to be depositing the money? Do we have a security guard, making sure everyone's safe? Are we keeping the appropriate records? So we're going to move on now to passive income, which is more of the set it and forget it. Think investment portfolio. So what are the traditional investments I'm talking about? This is stocks, mutual funds, bonds. We're lucky enough as an organization to have a large lump sum of money. We're seeing it recently with a lot of the ERC, the employee retention credits, and the the PPP loans. Sometimes people, once they made themselves whole, still had a hunk of money and didn't quite know what to do with it. So they were like, for the first time, we're in a position where we can have a rainy day fund. We don't want it to just sit there idly. So let's put it in a bond in the stock market based on your risk tolerance. So we've got these traditional investments. Income is excluded under 512. So interest, dividends, the gain of sale of all these traditional investments. Tax-exempt organizations don't pay tax on that, right? So that is why organizations would set up those C Corp blockers, report the UBI, and then the dividends that they pay back to the organizations are tax-free under 512. There's also alternative investments, and these are a little more complicated, right? So these are publicly traded partnerships, hedge funds, private equity. Once we start investing in these, let's say you got a hotshot investment advisor who's guaranteeing you these big returns, he may park a lot of your money in these. That's fine. You may get great returns. I'm not telling you not to do it. But with those, comes a lot more reporting complexity and compliance cost. We're going to talk about that in a little bit. So what are the tax considerations when we're talking about investments? If we got those traditional investments, none, it's all exempt. But when we see with the PTP hedge fund and private equity, these K1s that you receive, which is all of that flow through information that I talked about earlier, they're massive. Some of the ones me and Taylor review can be up to 80, 90 pages. It's also very common for these to have separate state reporting requirements based on the unrelated business income. A lot of these entities invest in trader businesses that are not going to be related to your tax exempt purpose. So they're going to generate UBI. They also, if they're in the private equity world, will make offshore investments and funnel monies into these investments in other parts of the world. What happens there is if they reach certain thresholds, you have to file the appropriate foreign disclosure forms. There's no tax associated with that, but the IRS closely scrutinizes any money that's going overseas. And with those, you're going to have increased reporting requirements with the foreign and state reporting, and then increased compliance costs. Because like I said, those K1s can be very complicated and very large. And folks like Taylor and myself, we need to go through every page to make sure we're covering ourselves. The danger with those foreign investments is if you don't do what you're supposed to do, the penalties related to non-compliance are very steep. I think the cheapest penalties are around $10,000. So you really got to make sure that you know what you're getting into. If we're going to go and get into these more complex investments, these alternative investments, it's really important that we heavily think about our governance factors here. Do we have an investment committee? We definitely need competent folks on the board overseeing this. Maybe some investment advisors on board so they can be part of a sub-investment committee, making sure that our investment advisor has experience with nonprofits or is willing to work with us to understand the nuances of what we are willing or not willing to invest in. Are the fees reasonable? Related party transactions, making sure we're abiding by our conflict of interest policy, that the board president's husband isn't the one managing our $8 million portfolio, or if he is, he's charging us fair market value. Those kind of things, making sure we're aware of all that. If we have an endowment, if we're lucky enough to be in that provision, or do we understand the different parts of our endowment policy? Are we abiding that? And then also, this is one a lot of folks don't think about, but with discussions with our investment advisors, are there any investment restrictions based on our charitable mission that we should let our investment advisor know about? Let's say we are a environmental organization that's out there trying to save the environment, and we are heavily invested in oil and gas companies or whatever companies that is heavily invested in one of those companies that is a repeat offender in our community for environmental violations. It would probably look bad if it ever got out that a hunk of our money was invested with these types of for-profit entities if our entire charitable mission is to rally against them, to educate the public on some of the things they're doing. Let's say we work with the recently incarcerated or they're incarcerated. It'd probably be bad if a hunk of our investment portfolio was invested in private prisons. Maybe it's not prohibited from a governance standpoint, but just the optics of it, were that to ever get out, is that something that we as an organization would be comfortable with? So just another level of complexity that we need to think about when we are getting into more complex investments. So then the last slide that we are going to have is rental income. So typically rental income is excluded unless it is debt financed. So if we buy a building with pure cash, all that rental income, we don't pay tax on. If we have to take a loan out and then we rent that out, there's the debt finance rules that kick in. We have to do a different set of analysis, which I won't get into now. Where do we see this a lot? A lot of times an organization will buy a building, whether and have to mortgage it. They thought they were going to use all 3 stories. Times got tough, like through the last few years, we kind of laid off staff, or we decided we really don't need to use the 3rd floor. Wouldn't it be great if we combined all our staff in the first 2 floors and then we rent out half that 2nd floor and then the entire 3rd floor? Well, inadvertently, we just stepped into a puddle there because we are now using a debt financed building to generate rental income. So we just need to understand those rules, make sure we report the appropriate information and file all appropriate tax returns. So that's kind of the UBI rules and the compliance things we need to be aware of. But then also let's think about the governance considerations when it comes to rental income. One, staffing and expertise. Do we have anyone on the board who has experience with commercial real estate? Do we have anyone on the board who is a contractor who can help us kind of look at the building, make sure that we have good contacts in order when we need to fix something? Another thing we have to think about is when we own the entire building and a light goes out on the third floor, not the end of the world, we can keep on doing that. We don't have to change that light bulb. But if we have a tenant in there, we got to fix that light bulb quickly. And maybe it's not just a light bulb, but it's a part of the AC unit. If we're not using the third floor, it's just us, that AC on the third floor goes out, we're not going to buy a new $20,000 commercial AC. But if we have a tenant up there and we have to buy an AC, do we have the appropriate funds set aside to do that? Do we have a line that we can tap into? Do we have some sort of credit that we can tap into to make sure that we can do that? So we have to factor that in with our budgeting discussions, because now we have to worry about, do we have a capital projects fund? Do we have money set aside in those, in case of emergency break glass days where the AC goes out and our tenant's sweating, we got to get in there and fix it quickly. So we also have to understand we're now going to have leases. We got to have the appropriate legal counsel kind of look over all that information for us. So just another thing we got to think about. So again, we just wanted to make you aware of all the things that are out there, the risks, the exposure that you could have as an organization if we take on different revenue streams. We don't want to tell you that any of these are better than the other. What fits for one organization may not work for another, and vice versa, right? So make sure if you're starting to diversify your revenue streams, that if you're going into something that we've talked about, that there needs to be UBI analysis. Talk to your CPA, talk to those on the board who have experience in this, and just make sure that everyone is on the same page. So with that, we're going to open it up to questions. So let me scoot over so Taylor can get on here. So would a church calling the parking space fee a donation get away with it not being UBI? So a lot of this stuff is facts and circumstances, right? So just because we call something a donation doesn't necessarily mean that it is a donation, right? So in the IRS's eyes, they would look and say, okay, did this donor receive something for those funds? And so they would look in and say, okay, you gave the church $15, but then that church let you use its parking lot for Jazz Fest, whatever, for a period of time. So you got something in return. So the IRS would then go down that analysis of, okay, there was a transaction between the two. It wasn't purely a donation out of the goodness of their heart. So that is a common question we get. Can we just call it this and go about our business? And you really got to look down, okay, if there is that quid pro quo, if we're getting something for something, we got to do a second layer of analysis. And then the other church parking lot for sports events by volunteer workforce. With that, we would then go down all of the normal UBI exceptions. The 1, 2, 3, is it regularly carried on? Is it a trade or business? And then is it related? So how often are we doing this church sports event? If it's a, we have, I'm trying to think of an example, a 1 day a year basketball game that comes in, and we do that. We rent out the parking lot because we're a couple blocks away from where the term is held. Maybe that doesn't meet the regularly carried on, as opposed to every season long. Yes, a whole basketball season long. So that's a different analysis, and we just got to get comfortable with that. Like this question said, though, volunteer workforce, we may be able to get out of some of these exceptions is if the entire parking process is planned, run, and executed by a volunteer workforce. So great question. As with any tax law, there's the rule, there's the exception, and then there's the exception to the exception. So I highly recommend that anytime you start expanding your revenue sources, please sit down, do your initial analysis, talk to those in your organization or outside your organization that you trust that have experience, call your CPA. If your current CPA isn't well-versed in nonprofit law, see if they have anyone they can recommend to tap into. And as always, we're happy to help whenever needed. So that was all the questions that we got in. We're just going to check one more time. Yep. So just some final thoughts here. Just want to thank everyone for attending today. It means a lot to us that you would take some time out of your day to listen to what we have to say. We will be having more of the summer series this year. Like I said, this was just a kickoff event. The next nonprofit seminar will be on August 22nd, and those panelists will cover dashboards and then using data to achieve your objectives. We will be sending out invitations shortly for that session. So if you are on our email blast, you will be receiving those. If someone who had attended our first presentation this summer gave you the link for the second one and you would like to be added to our mailing list, let us know. Taylor and I's email is on the final slide here, and we will be happy to add you to let you know about all those other series. So again, thank you for attending. The evaluation form will be emailed out to everyone, so please keep an eye out so you can make sure you answer that to get the CPE credit. And with that, thank y'all, and I hope everyone has a good rest of the day. Bye, y'all.
Thanks, everyone.